It seems to happen every year. As we head into the summer months, energy prices begin to skyrocket. And that's the topic in this week's Market Watch.
Market Watch, brought to you by Pfizer Animal Health.
And joining me in the studio today is Warren Prosser, market analyst with CattleFacts. Warren, thanks for coming to the show.
Good to be here, Kevin.
Well, first of all, just tell us what's occurring currently in the energy markets.
Well, the biggest thing that's been going on that's noteworthy is the recent rise in gasoline futures. They've gone up about 30-40 cents since the beginning of the year, and that's not trivial as we're going to deal with record high prices this spring. As we look into the April and spring, summer time frame, the futures are already telling us that we could see record high prices.
Wow. Well, what is driving these record high prices, and how long do you expect them to continue?
I think what's really driving it is the disparity between the U.S. economy and the global economy. And so we've been exporting fuel. China has record imports as of January. And the Middle East tension has also escalated that. But as we look further out, I think we'll find that we have record speculators in the oil market. Gasoline consumption is now falling in the U.S. to mid-1995 levels on a per capita basis, and Chinese auto sales have cooled off, down 27% year over year.
Really?
So as we look out, we can say we'll actually see them higher into this summer as the market does its job to ration demand, but the fundamentals will tell us that by the second half of the year, we could see a substantial drop in prices.
Interesting. So relate that to the cattle market. What impact is that going to have on the cattle business at large?
Well, I think it's more than twofold. You know, it's complex because we all know that it'll impact our break-evens, our prices as producers, but we also know that cattle that are further away from feed yards or packers will have to pay a discount because of freight prices. But I think the other way we can look at it is through ethanol. You know, we all talk about ethanol as it's 50% of corn usage, but as higher prices in gasoline, one would think that we'd have more ethanol usage. But the reality is higher prices ration the demand, which means lower ethanol usage for the U.S. So the way we're looking at it is as long as exports continue in both ethanol and gasoline, we can have higher prices in ethanol usage, but domestically we may actually see ethanol production slow.
Interesting. Well, thank you so much for your perspective. They're always very, very valuable to us.
Well, thank you. Appreciate to be here.
For more expert analysis, just visit cattlefacts.com.